Welcome to Invested Insider, your trusted source for the latest financial news and insights. My name is Amelia Hawthorne, and today is the 24th of July of 2023. Today we're going to dive into a hot topic that has been stirring financial markets: the Federal Reserve's stance on interest rates. The news from Wall Street and the voices of analysts and economists all seem to point towards one crucial event that could sway the fate of our economy. First off, let's get a clear understanding of the ongoing scenario. The Federal Reserve, the central banking system of the United States, is expected to make a significant announcement next week that might well be the final rate hike in what has been an aggressive monetary policy tightening cycle, the most vigorous we've seen in decades. At the beginning of this year, the forecast was grim. The prevalent sentiment among investors was that higher interest rates would trigger a recession, exacerbating the damage already done to stocks following a sharp decline in 2022. However, contrary to this, the U.S. economy is showing unexpected resilience even as the Fed continues its fight against inflation. In fact, the S&P 500 is up nearly 19% year to date, a surprising but welcome turn of events for the stock market. Now, looking ahead to the Federal Reserve's meeting on July 26th, investors anticipate a rate hike of 25 basis points. However, there is also hope for signs that policymakers have gained confidence in the ongoing cooling of inflation. This could potentially eliminate the need for the Fed to lift borrowing costs further and reinforce the factors that have been buoying stocks recently. Analysts are cautiously optimistic, expecting a benign macroeconomic backdrop and an end to the Fed's tightening cycle. This anticipation has led to some interesting revisions on how high stocks might go this year. Notable examples include Jonathan Golub of Credit Suisse, who raised his year-end target on the S&P 500 to 4,700 from 4,050, and Ed Yardeni of Yardeni Research, who predicts the S&P 500 at 5,400 in the next 18 months. Despite this optimistic sentiment, not everyone shares the bullish viewpoint. A fair share of the investment community remains bearish, citing concerns ranging from possible shortfalls during the ongoing earnings season to surprises in the durability of inflation. A key part of this discussion revolves around inflation. The inflation rate has been an unyielding and compelling driver for macroeconomic decisions. Its influence on the Fed's actions cannot be understated, and it will be a critical determinant for the market's future trajectory. Speaking of inflation, let's shift focus to a recent report on consumer inflation. It's been a relief to see headline consumer inflation plunge to a 3.1% annual rate in June, a steep fall from the high of 8.9% in the same month last year. This softening inflationary pressure is starting to convince the market that perhaps inflation is beginning to cool off naturally. However, there's another side to this story, as the core consumer inflation rate is currently at a 4.8% annual rate, which is still significantly above the Fed's 2% target. This lingering concern reminds us that while progress has been made, the journey to stable inflation is far from over. Of course, the labor market plays a vital role in this equation. The strong labor market has been one of the top surprises for economists this year. The nation's unemployment rate has been 3.7% or lower all year. Traditionally, it was thought that the unemployment rate would have to rise above 4.5% to bring inflation down. However, the recent good inflation news has come with continued strong job growth, leading to some hope for a combination of low inflation and a strong labor market. The Federal Reserve's upcoming meeting is therefore poised to be a decisive moment, not just for the U.S. economy, but for investors and consumers alike. The way the Fed responds to this economic crossroads could set the tone for the markets for the rest of the year. Remember, knowledge is power. Keeping an eye on these developments will equip you with the information you need to make informed decisions about your financial future. That's all we have for today. Stay tuned, and we'll catch up on the latest financial news in our next podcast.
The Invested Invested Insider podcast does not offer any financial, economic, legal, accounting, or tax advice or recommendations. The information provided in this podcast or on the associated blog should not be construed as investing or financial advice and should not be considered professional advice. The views, opinions, and content presented in this podcast do not represent the endorsement or approval of Invested Insider and assumes no responsibility for the accuracy or completeness of third-party materials or content referenced in the podcast.